Hi, everyone, and I appreciate you all being here today. I am live, and today we are going to be doing Chapter 3 of The Intelligent Investor by Benjamin Graham. And in his book, today we're doing Chapter 3. So thank you so much for being on the live. I appreciate you for being here. And we're going to begin right after I tell you a little bit about myself. My name is May Duldalau. All right, May Duldalau. May Duldalau. I live in Honolulu, Hawaii with my husband Jamal and my son Jordan. And I'm also on Instagram Live at the same time. So I've got YouTube and Instagram. If you're live on my blog is yesfinanciallyfree.com. Yesfinanciallyfree.com. If you're not on my email list, go there, put your first name and email address on the right side to always get notifications of when I am live and what I'll be talking about. I just emailed my email list right now and told them, but I already told them last week that I would be live every day at the same time reading this book. And the reason we're reading this book is because right now the stock market is an all-time low. This is the teacher of Warren Buffett, okay? Warren Buffett learned from this guy. So Warren Buffett is super, super rich. Now, if you want to get good at stock picking or buying when the market's low or knowing what to buy when the market is uncertain and industries might not survive, well, this is the book to read. So that's why I'm reading it. Ray Dalio predicts that this market crisis is going to last 3 years. So we have more than enough time to read these books and learn what we need to learn to get wealthy right now, okay? Now, I didn't always used to be good with money. I used to be really bad with money. In 2008, 2009, 2011, I had a lot of debt. In 2011, my debt was over $41,000 something of debt. And that's credit card debt, line of credit debt. I didn't own any property, so I didn't have any good debt. It was just debt, okay? And it was on it was like 8 or 9 different credit cards, lines of credit. It was like a lot of stuff going on in my life. So I want you guys to understand that I was not always good with money. I started out being pretty bad at it. And I was a smart person. I had a job. I worked at a bank, but I wasn't good with my money, right? And the bank started to help me. My boss at the bank, he taught me how to, he taught me how to consolidate my debt, which helped me in the beginning. And then I ended up getting more debt. So it helped me, but it's all good. And then he also taught me how to track my net worth, he taught me how to calculate my net worth. I also learned it from various gurus and teachers and stuff. So that helped me a lot. I learned how to calculate my net worth. I now keep track of it every month. But long story short, I went from all that debt. And I married my husband in 2012. We had a baby, Jordan. He's actually 6 years old now. But by 2016, all the debt was gone. And my husband had more debt than me. He had 6-figure debt, over $200,000 of debt. Okay, guys. So we improved our net worth by 2016 by $500,000. All right. And we didn't work extravagant jobs. Okay. I worked as a banking assistant. My salary was like $34,000 a year before taxes are taken out. Okay, guys. All of my debts were gone. We were making almost $500 a month in passive income every month. Improved our net worth by $500,000. And I quit my job because I could. We bought our first property 2017, the second property 2018. We sold one property to one of my mastermind. I started coaching. Finance Freedom, Finance Freedom mastermind programs in 2016. Created 3 masterminds. Created these programs to help people learn what I did, which is pay off debt, but at the same time, create passive income and create real wealth. All right. Hence, we track the net worth and the passive income at the same time. So I started doing that as well. So full-time mommy, part-time investor, finance freedom mastermind coach, and I blog at yesfinanciallyfree.com. Tons of information there. So put your first name and email address on the right side to get on my email list. So long story short, bought property. I have a mastermind group, sold one property to a mastermind member. He was making profit for this whole financial pandemic, but it was a good deal for him. It was a good deal for us. We bought another property, which is our third purchase in 3 years. But we own 2 properties now, and it's this condo where we live. And it's a beautiful 2-bedroom condo upgrade, twice the size of our other condos. And so our lifestyle keeps improving. During this pandemic right now, we're actually okay for money. And we live right by the beach. So that's the biggest thing, is we can just walk outside and jump in the water every day if we want. We're allowed to go in the water here. We're not allowed to hang out on the beach, but we're allowed to go in the water. So we go in the water, hang out in the water, we float, we body surf, we boogie board, we surf. We have a very healthy lifestyle. And I attribute all this and a lot of this to Finance Freedom Mastermind. If I was in the state I was in before, I don't know if I would be able to get through this very well. And I do know friends who I've talked to who are filing for personal bankruptcy right now. So if you're having financial issues, financial problems, I want you to understand that there is a way to become wealthy, to become financially free. And it doesn't matter what your job is, or if you have debt, or what your financial situation is, you can do it. You just have to make a choice. And that's what my clients and what we work on together is everyone financially free, right? And the blog, again, yesfinanciallyfree.com. All my products are on the products page. You can join a mastermind there if you like. You can get a free ebook when you join my email list, The Working Parent's Guide to Financial Freedom. I also have products that range from $7 to $5,000 on the products page. So check it out and see if something there can help you become financially free. Use this opportunity, this pandemic, to change your life and actually improve your finances. So that's my story in a nutshell. I didn't say that I traveled a month in 2017. We went all over. We went to Toronto, Niagara Falls, visited relatives, Washington, D.C., LA. We went on a cruise to Mexico. So there was a lot that happened in 2017. I quit my job right before Christmas in 2016. And 2017 was like, yay. So it was an amazing time. And I want to tell you that every year, and I'm still in this business. I've been gone as what people have been congratulating me on LinkedIn, right? Oh, congratulations on your work anniversary. 6 years already. 6 years I've been doing this. Kind of blows my mind. So anyway, let's begin. We're going to read. People who know me know that what I do is I focus on personal growth. And I believe that we can all rise up together, but we have to take the time to learn what we need to learn, okay? We're not just going to be sitting there believing and not doing anything. So let's learn together. So Benjamin Graham, The Intelligent Investor, Chapter 3, A Century of Market History, The Level of Stock Prices in Early 1972. This book is kind of older, guys. So Ben Graham he's passed away, just so you understand. Okay. The investor's portfolio of common stocks will represent a small cross-section of that immense and formidable institution known as the stock market. Prudence suggests that he have an adequate idea of stock market history. In terms particularly of the major fluctuations in its price level and of the varying relationships between stock prices as a whole and their earnings and dividends. With this background, he may be in a position to form some worthwhile judgment of the attractiveness or dangers of the level of the market as it presents itself at different times. By coincidence, useful statistical data on prices, earnings, and dividends go back just 100 years to 1871. The material is not nearly as full or dependable in the first half period as in the second, but it will serve. In this chapter, we shall present the figures in highly condensed form with 2 objects in view. The first is to show the general manner in which stocks have made their underlying advance through the many cycles of the past century. The second is to view the picture in terms of successive 10-year averages, not only of stock prices, but of earnings and dividends as well, to bring out the varying relationship between the 3 important factors. With this wealth of material as a background, we shall pass to a consideration of this level of stock prices at the beginning of 1972. The long-term history of the stock market is summarized in 2 tables and a chart. Table 3.1 sets forth the low and high points of 19 bear and bull market cycles in the past 100 years. we have used two indexes here. The first represents a combination of an early study by the Cowles Commission going back to 1870, which has been spliced onto and continued to date in the well-known Standard & Poor's Composite Index of 500 stocks. The second is an even more celebrated Dow Jones Industrial Average, the DJIA, or the Dow, which dates back to 1897. It contains 30 companies, of which one is American Telephone and Telegraph, AT&T, and the other 29 are large industrial enterprises. As you know, AT&T has been around for quite a while. Doesn't mean they'll stay in business, but okay. So this is the chart that he has on the page, just so you can kind of get an idea what it looks like. Okay, I might put it on my blog as well. So if you're on my blog, you might be able to see it at a later date. If you're watching the live, this is what the chart looks like. So if you're on a phone, you can screenshot it now. Okay, if you're on your computer, you can screenshot the chart. Okay, guys. All right. Okay, so let's keep going. By the way, subscribe. If you're on Instagram, click on the link in the profile and share this with people. Share the blog. Share the knowledge. Right? And if you're really on this with me, you're a true geek, because only geeks are interested in what I'm doing. And if you're a true geek, you're fine. You're going to be fine. Okay. So they look at this major stock market swings between 1871 and 1971. And they're showing you the decline or the increase, right? And in 1885, there was a 28% decline. 1893, there was a 31% decline. 1897, they had a low of 38.85. So, and there's highs and lows. Decline. I don't know if that one is a percent and the rest are points. Okay, sorry. And the one on the left is the Cal Standard 500 Composite. The one on the right is the Dow Jones. Okay, got it. Okay. All right, so it's a little spotty because they don't have tons of historical information in the 1800s. Then they go all the way to 1972, early 1972. And they show the points decline and the points high and low. Okay. All right, so it's a bunch of data. All right. So we'll just read and see what they interpret it as. Okay. Chart 1, presented by courtesy of Standard & Poor's, depicts the market fluctuations of its 425 industrial stock index from 1900 through 1970. A corresponding chart available for the Dow Jones Industrial Average will look very much the same. That's the chart. So you can screenshot that. Okay. You can screenshot that. Standard & Poor's stock market. Okay. So there's a chart here from 1900 to 1970. And it shows the Standard & Poor's, how it was the overall value, I think. Monthly average value of 425 stocks. Yeah. So it's monthly going up on average. Okay. All right. The reader will note three quite distinct patterns, each covering about a third of the 70 years. The first runs from 1900 to 1924 and shows, for the most part, a series of rather similar market cycles lasting from 3 to 5 years. The annual advance in this period averaged just about 3%. We move on to the new era bull market, culminating in 1929 with its terrible aftermath of collapse, followed by quite irregular fluctuations until 1949. So it took 20 years for it to stabilize. Comparing the average level of 1949 with that of 1924, we find the annual rate of advance to be a mere 1.5%. Hence, the close of our second period found the public with no enthusiasm at all for common stocks. But the rule of opposites, the time was ripe for beginning of the biggest bull market in our history, presented in the last third of our chart. This phenomenon may have reached its culmination in December 1968 at 118 for Standard & Poor's 425 Industrials and 108 for its 500 stock composite. As Table 3.1 shows, there were fairly important setbacks between 1949 and 1968, especially 1956 to 1957 and 1961 to 1962. But the recoveries therefrom were so rapid and that they had to be denominated in the long in the long accepted semantics as recessions in a single bull market rather than as separate market cycles. Between the low of 162 for the Dow and in the mid 1949 and the high of 995 in early 1966, the advance has been more than sixfold in 17 years, which is at the average compounded rate of 11% per year, not counting dividends of, say, 3.5% annum. The advance for the Standard & Poor's Composite Index was somewhat greater than that of the Dow Jones Industrial Average, actually from 14 to 96. These 14% and better returns were documented in 1963 and later in a much publicized study. It created a natural satisfaction in Wall Street with such fine achievements and a quite illogical and dangerous conviction that equally marvelous results could be expected for common stocks in the future. Few people seem to have been bothered by the thought that the very extent of the rise might indicate that it had been overdone. The subsequent decline from 1968 to the 1970 low was 36% for the Standard & Poor's Composite and 37% for the Dow Jones Industrial Average, the largest since the 44% suffered in 1939 and 1942. I think our market has suffered a huge loss in the same capacity of the Great Depression, according to Ray Dalio, which had reflected the perils and uncertainties after Pearl Harbor. In the dramatic manner so characteristic of Wall Street, the low level of May 1970 was followed by a massive and speedy recovery of both averages and the establishment of a new all-time high for the Standard & Poor's Industrials in early 1972. The annual rate of price advance between 1949 and 1970 works out at about 9% for the S&P Composite or Industrial Average Index, using the average figures for both years. That rate of climb was, of course, much greater than that for any similar period before 1950. But in the last decade, the rate of advance was much lower, 5.25% for the S&P Composite Index, and only the once familiar 3% for the Dow Jones Industrial Average. The record of price movements should be supplemented by corresponding figures for earnings and dividends in order to provide an overall view of what has happened to our share economy over the 10 decades. We present a conspectus of this kind in our table 3.2 on page 32. Okay, this is table 3.2, so you can copy that image if you want, and then this is 3.2 for Instagram people. Okay, but basically it's a table. It looks like it has a picture of stock market performance from 1871 to 1970, and it just shows the average price, average earnings, price divided by earnings, ratio, dividend average, average yield, average payout, and earnings and dividends, annual growth rate. So according to this, 1871 to 1880 had the highest average payout and the highest average yield. And the second place would be, the highest one was 1941 to 1950, had a 6.3% average yield, 60% average payout. Yeah. Since then, it's been like 3%, 4, then 3, 4, 3, 3%. And that's the 1970. Okay, so this book is dated, but okay. Okay, so let's go back. Did I finish reading that part? Let's go back. Okay. The record of price movements should be supplemented by corresponding figures for earnings and dividends in order to provide an overall view of what has happened to our share economy over the 10 years. We present a conspectus of this kind in our table 3.2 on page 32. It is a good deal to expect from the reader that he study all these figures with care, but for some, we hope they will be interesting and instructive. Let us comment on them as follows. The full decade figures smooth out the year-to-year fluctuations and leave a general picture of persistent growth. Only 2 of the 9 decades after the first show a decrease in earnings. Sorry. Okay. The full decade figures smooth out the year-to-year fluctuations and leave a general picture of persistent growth. Over 2 of the 9 decades after the first show a decrease in earnings and average prices. That's 1891 to 1900 and 1931 to 1940. And no decade after 1900 shows a decrease in average dividends. But the rates of growth in all 3 categories are quite variable. In general, the performance since World War II has been superior to that of earlier decades, but the advance in the 1960s was less pronounced than that of the 1950s. Today's investor cannot tell from this record what percentage gain in earnings, dividends, and prices he may expect in the next 10 years, but it does supply all the encouragement he needs for a consistent policy of common stock investment. However, a point should be made here that it is not disclosed in our table. The year 1970 was marked by a definite deterioration in the overall earnings posture of our corporations. The rate of profit on invested capital fell to the lowest percentage since the World War years. Equally striking is the fact that a considerable number of companies reported net losses for the year. Many became financially troubled, and for the first time in 3 decades, there were quite a few important bankruptcy proceedings. These facts, as much as any others, have prompted the statement made above that the great boom era may have come to an end in 1969-1970. A striking feature of Table 3.2 is the change in the price-earnings ratios since World War II. In June 1949, the S&P Composite Index sold at only 6.3 times the applicable earnings of the past 12 months. In March 1961, the ratio was 22.9 times. Similarly, the dividend yield on the S&P index had fallen from over 7% in 1949 to only 3% in 1961. A contrast heightened by the fact that interest rates on high-grade bonds had meanwhile risen from 2.6% to 4.5%. This is certainly the most remarkable turnabout in the public's attitude in all stock market history. To people of long experience and innate caution, the passage from one extreme to another carried a strong warning of trouble ahead. They could not help thinking apprehensively of the 1926 to 1927 bull market and its tragic aftermath. But these fears have not been confirmed by the event. True, the closing price of the Dow Jones Industrial Average in 1970 was the same as it was 6.5 years earlier, and the much heralded soaring 60s proved to be mainly a march up a series of high hills and then down again. But nothing has happened either to business or to stock prices that can compare with the bear market and depression of 1929 to 1932. Well, I guess now we know what it feels like. Okay, the stock market level in early 1972. With a century-long conspectus of stock prices, earnings, and dividends before our eyes, let us try to draw some conclusions about the level of 900 for the Dow Jones Industrial Average and 100 for the S&P Composite Index in January of 1972. In each of our former editions, we have discussed the level of the stock market at the time of writing and endeavored to answer the question whether it was too high for conservative purchase. The reader may find it informing to review the conclusions we reached on these earlier occasions, that it is not entirely an exercise in self-punishment. It will supply a sort of connecting tissue that links the various stages of the stock market in the past 20 years, and also a taken-from-life picture of the difficulties facing anyone who tries to reach an informed and critical judgment of current market levels. Let us first reproduce a summary of the 1948, 1953, 1955 analyses that we gave in the 1965 edition. In 1948, we applied conservative standards to the Dow Jones level of 180 and found no difficulty in reaching the conclusion that it was not too high in relation to underlying values. When we approached this problem in 1953, the average market level for that year had reached 275, a gain of over 50% in 5 years. We asked ourselves the same question, namely, whether, in our opinion, the level of 275 for the Dow Jones Industrials was or was not too high for sound investment. In the light of the subsequent spectacular advance, it may seem strange to have to report that it was by no means easy for us to reach a definitive conclusion as to the attractiveness of the 1953 level. We did say positively enough that from the standpoint of value indications, our chief investment guide, the conclusion about 1953 stock prices must be favorable. but we were concerned about the fact that in 1953, the averages had advanced for a longer period than in most bull markets of the past, and that its absolute level was historically high. Setting these factors against our favorable value judgment, we advised a cautious or compromised policy. As it turned out, this was not a particularly brilliant counsel. A good prophet would have foreseen that the market level was due to advance an additional 100% in the next 5 years. Perhaps we should add in self-defense that few, if any, of those whose business was stock market forecasting, as ours was not, had any better inkling than we did of what lay ahead. At the beginning of 1959, we found the Dow Jones Industrial Average at an all-time high of 584. Our lengthy analysis made from all points of view may be summarized in the following from page 59 of the 1959 edition. In sum, we feel compelled to express the conclusion that the present level of stock prices is a dangerous one. It may well be perilous because prices are already far too high. But even if this is not the case, the market's momentum is such as inevitably to carry it to unjustifiable heights. Frankly, we cannot imagine a market of the future in which there will never be any serious losses, and in which every tyro will be guaranteed a large profit on his stock purchases. The caution we expressed in 1959 was somehow better justified by the sequel than was our corresponding attitude in 1954. Yet it was far from fully vindicated. The Dow Jones Industrial Average advanced to 685 in 1961 and then fell a little below our 584 level to 566 later in the year. Advanced again to 735 in late 1961 and then declined in near panic to 536 in May of 1962, showing a loss of 27% within the brief period of 6 months. At the same time, there was a far more serious shrinkage in the most popular growth stocks, as evidenced by the striking fall of the indisputable leader, International Business Machines, IBM, from a high of 607 in December of 1961 to a low of 300 in June of 1962. The period saw a complete debacle in a host of newly launched common stocks of small enterprises, the so-called hot issues, which had been offered to the public at ridiculously high prices and then had been further pushed up by needless speculation to levels little short of insane. Many of these lost 90% and more of the quotations in just a few months. The collapse in the first half of 1962 was disconcerting, if not disastrous, to many self-acknowledged speculators and perhaps to many more imprudent people who call themselves investors. But the turnabout that came later that year was equally unsuspected by the financial community. The stock market averages resumed their upward course, producing the following sequence. December of 1961, the Dow Jones Industrial Average was at 735, and the Standard & Poor's was at 72.64. In June of 1962, the Dow Jones Industrial Average went down to 536, and then S&P went down to 52.32. But in November 1964, the Dow Jones Industrial Average was at its highest ever of 892, and so was Standard & Poor's at 86.28. The recovery and new ascent of common stocks was indeed remarkable and created a corresponding revision of Wall Street sentiment. At the low level of 1962, predictions had appeared predominantly bearish, and after the partial recovery to the end of the year, they were mixed, leaning to the skeptical side. But at the outset of 1964, the natural optimism of brokerage firms was again manifest. Nearly all the forecasts were on the bullish side, and they so continued through the 1964 advance. So he's done quoting now. We then approached the task of appraising the November 1964 levels of the stock market, 892 for the Dow Jones Industrial Average. After discussing it learnedly from numerous angles, we reached three main conclusions. The first was that old standards of valuation appear inapplicable. New standards have not yet been tested by time. The second was that the investor must base his policy on the existence of major uncertainties. The possibilities compass the extremes, on the one hand, of a protracted and further advance in the market's levels, say by 50%, or to 1350 for the Dow Jones Industrial Average, or on the other hand, of a largely unheralded collapse of the same magnitude, bringing the average in the neighborhood of, say, 450. The third was expressed in much more definite terms. We said, speaking bluntly, if the 1964 price level is not too high, how could we say that any price level is too high? And the chapter closed as follows. What course to follow? Investors should not conclude that the 1964 market level is dangerous merely because they read it in this book. They must weigh our reasoning against the contrary reasoning they will hear from most competent and experienced people in Wall Street. In the end, each one must make his own decision and accept responsibility therefore. We suggest, however, that if the investor is in doubt as to which course to pursue, he should choose the path of caution. The principles of investment as set forth herein would call for the following policy under 1964 conditions in order of urgency. No borrowing to buy or hold securities. No increase in the proportion of funds held in common stocks. A reduce in common stock holdings where needed to bring it down to a maximum of 50% of the total portfolio. The capital gains tax must be paid with as good grace as possible, and the proceeds invested in quality bonds or held as a savings deposit. Investors who for some time have been following a bona fide dollar cost averaging plan can in logic elect either to continue their periodic purchases unchanged or to suspend them until they feel the market level is no longer dangerous. We should advise rather strongly against the initiation of a new dollar averaging plan in the late 1964 levels, since many investors would not have the stamina to pursue such a scheme if the results soon after initiation should appear highly unfavorable. This time we can say that our caution was vindicated. The Dow Jones Industrial Average advanced about 11% further to 995 and then fell irregularly to a low of 632 in 1970 and finished that year at 839. The same kind of debacle took place in the price of hot issues, with declines running as much as 90%, as it happened in 1961 to 1962 setback. As pointed out in the introduction, the whole financial picture appeared to have changed in the direction of less enthusiasm and greater doubts. A single fact may summarize the story. The Dow Jones Industrial Average closed in 1970 at a low level lower than 6 years before, the first time such a thing happened since 1944. Such were our efforts to evaluate former stock market levels. Is there anything we and our readers can learn from them? We considered the market level favorable for investment in 1948 and 1953, but too cautiously in the latter year dangerous in 1959 at 584 for Dow Jones Industrial Average and too high at 892 in 1964. All of these judgments could be defended even today by adroit arguments, but it is doubtful that if they had been as useful as our more pedestrian counsels in favor of a consistent controlled common stock policy on the one hand and discouraging endeavors to beat the market or to pick winners on the other. Nonetheless, we think our readers may derive some benefit from a renewed consideration of the level of the stock market. This time, as of late 1971, even if what we have to say will prove more interesting than practically useful or more indicative than conclusive, there is a fine passage near the beginning of Aristotle's Ethics that goes, "It is the mark of an educated mind to expect that amount of exactness which the nature of a particular subject admits. It is equally unreasonable to accept merely probable conclusions from a mathematician and to demand strict demonstration from an orator. The work of a financial analyst falls somewhere in the middle between that of a mathematician and of an orator." At various times in 1971, the Dow Jones Industrial Average stood at the 892 level of November 1964 that we considered in our previous edition. But in the present statistical study, we have decided to use the price level and the related data for the Standard & Poor's Composite Index because it is more comprehensive and representative of the general market than the 30 stock Dow Jones Industrial Average. We shall concentrate on a comparison of this material near the 4 dates of our former editions, namely the year ends of 1948, 1953, 1958, and 1963, plus 1968. For the current price level, we shall take the convenient figure of 100, which was registered at various times in 1971 and in early 1972. The salient data are set forth in Table 3.3. For our earnings figures, we present both the last year's showing and the average of 3 calendar years. For 1971 dividends, we use the last 12 months figures, and for 1971 bond interest and wholesale prices, those of August 1971. Okay. Before I continue, I'll just show you the chart. If you have a way of taking pictures of your screen, go ahead. And then for Instagram, same with you. You can take a picture if you like. Okay. So I'm looking at this chart real quick. Data relating to Standard & Poor's composite index in various years. So they have 1948, 1953, 1950, 1963, 1968, 1971, and they have the closing price ended in current year, average earnings of the last 3 years, dividend in current year, high grade bond interest, wholesale price index. They have ratios of price to last year's earnings, price to 3 years earnings, 3 years earnings yield, dividend yield, stock earnings yield per bond yield divided by bond yield, dividend yield divided by bond yield, and earnings divided by book values. They've got a lot of different kinds of metrics on this thing. Okay, so let's keep reading, okay? Welcome to the live. Share this with your friends and followers. Subscribe to the channel. Okay. The 3-year price earnings ratio for the market was lower in October of 1971 than at year-end 1963 and 1968. It was about the same as in 1958, but much higher than in the early years of the long bull market. This important indicator, taken by itself, could not be construed to indicate that the market was especially high in January of 1972. But when the interest yield on high-grade bonds is brought into the picture, the implications become much less favorable. The reader will note from our table that the ratio of stock returns, earnings divided by price, to bond returns has grown worse during the entire period, so that the January 1972 figure was less favorable to stocks. By this criterion than in any of the previous years examined, when dividend yields are compared with bond yields, we find that the relationship was completely reversed between 1948 and 1972. In the early years, stocks yielded twice as much as bonds. Now bonds yield twice as much and more than stocks. Our final judgment is that the adverse change in the bond yield stock yield ratio fully offsets the better price earnings ratio for late 1971, and based on the 3-year earnings figures, hence our view, the early 1972 market level would tend to be the same as it was some 7 years ago, that it is an unattractive one from the standpoint of conservative investment. This would apply to most of the 1971 price range of the Dow Jones Industrial Average between, say, 800 and 950. In terms of historical market swings, the 1971 picture would still appear to be one of irregular recovery from the bad setbacks suffered in 1969 to 1970. In the past, such recoveries have ushered in a new stage of the recurrent and persistent bull market that began in 1949. This was the expectation of Wall Street generally during 1971. After the terrible experience suffered by the public buyers of low-grade common stock offerings in the 1968-1970 cycle, it is too early in 1971 for another twirl of the new issue merry-go-round. Hence, the dependable sign of imminent danger in the market is lacking now, as it was at the 892 level of the Dow Jones Industrial Average in November of 1964, considered in our previous edition. Technically, then, the outlook would appear to favor another substantial rise far beyond the 900 Dow Jones Industrial Average level before the next serious setback or collapse. But we cannot quite leave the matter there as perhaps we should. To us, the early 1971 market's disregard of the harrowing experiences of less than a year before is a disquieting sign. Can such heedlessness go unpunished? We think the investor must be prepared for difficult times ahead, perhaps in the form of a fairly quick replay of the 1969-1970 decline, perhaps in the form of another bull market fling to be followed by a more catastrophic collapse. What course to follow? Turn back to what we said in the last edition, reproduced on page 35. This is our view of the same price level, say 900, for the Dow Jones Industrial Average in early 1972 as it was in late 1964. Okay. And then they have a footnote here. I'm not sure where the footnote goes, but I'll read the footnote. Oh, it goes at the end. Okay. This was first written in early 1971 with the Dow Jones Industrial Average at 940. The contrary view held generally in Wall Street was exemplified in a detailed study which reached a median valuation of 1520 for the Dow Jones Industrial Average in 1975. This would correspond to a discounted value of, say, 1200 in mid-1971. In March 1972, the Dow Jones Industrial Average was again 940, and after an intervening decline to 798. Okay, so that's his history of stock market prices for the last 100 years. It goes to 1972. And the basic conclusion is that there is really no way to predict the market anymore. If you do it based on valuation, it doesn't mean you're going to get it right, because people will invest in the market when it is overvalued for substantially long periods of time. So that is not a satisfactory method. Now, he said that if you have stocks over 50%, you need to balance your portfolio so stocks don't go over 50%. He also says that if you're doing dollar cost averaging, if you have a plan and you've been doing it, you can keep doing it or stop. And that was in 1972. So we just had, as you all know, a huge market decline because of this pandemic. And so we shall see. But according to Ray Dalio, cash is trash. So you shouldn't be leaving it in a savings account. Okay, maybe bonds, I guess, maybe, but not savings. So good to know, right, guys? Anyway, we're going to do chapter 4 tomorrow. So stay tuned. And I really appreciate you being on the live. So what you want to do is go to the blog, yesfinanciallyfree.com. If you're on Instagram, click on the link in the profile. If you are on YouTube, it's going to be a link in the description. But you can also just go there, yesfinanciallyfree.com. Put in your first name, email address on the right side to get on the email list and get the free ebook, Working Parents Guide to Financial Freedom, right? And you'll also get great emails from me about when I will be live, what I'll be talking about. So it's a good reminder on how to continue your education and to become financially free. Financial freedom and wealth is in our mind. You might not believe it, but it starts here. So improving our mind will make us all wealthier. All right. Now, I don't know how you're doing. We're doing pretty well considering in this financial crisis, we have good state of mind. We're calm. We go exercising. We eat healthy. We have more than enough money to pay our bills and to eat. And we own 2 properties. So we have a lot going for us right now that a lot of people don't. And I appreciate and I'm grateful for this. And I'm grateful that I can be of service to you, especially during these hard times. Now, if you have a difficulty concentrating on learning because you're so worried, that might be your next step, is to work through that and let go of the worry, because that won't help you. We have to open up ourselves to more knowledge and more wisdom to change our circumstances. But anyway, thank you so much for being here. I so appreciate you. Thank you. And whatever you're going through, it will get better. All right. Life will give you a good turn. If you're at a low, it's sometimes good to hit a low before you hit a high, and I've been there. I've been at financial lows, so I understand how they feel. And I'm with you. Appreciate you. Love you. I'll see you again soon. Aloha and take care. Bye.